Hey guys, welcome back to another video for FAR 1. In this one, we're just going to go through a quick overview of what is non-monetary exchange, covered in chapter 10, pages 516 to 520. Basically, what is a non-monetary exchange? Well, just a quick definition, it's just exchanging an asset for an asset, okay? And there's no or little money involved in these transactions. And so let's just say that you have a truck and you want to trade it in for another truck. Well, that would be a type of non-monetary exchange. Or if two companies got together and swapped buildings or something like that, that would be another type of non-monetary exchange. Okay. Basically, there's a lot of rules around non-monetary exchange, and this is part of the class where you almost have to just kind of memorize the different treatments. There is, to actually solve for the journal entries, the numbers in the journal entries, I have a pretty good formula, and I'm going to show you how to use it and why it makes sense. But in terms of the different scenarios that we're going to walk through very quickly, we're just going to go through what they are. We're going to go through examples of them in another video. But this is one part of GAAP where it's very rules-based, and that's because of a lot of frauds that used to take place around these rules. So what used to happen was that a lot of companies would realize, oh, okay, like I have this piece of land and you have this piece of land, and you know they've both gone up in value. They're both higher than the book values on both of these companies. So the one has a piece of land, the other one has a piece of land sitting right next to it. They swap the pieces of land. They're identical in every single way imaginable. And the reason that they swap the land is so that way they can recognize these gains, right? But nothing has really happened in substance there. All that's happened is that these companies have swapped pieces of land. It's not as if they're in a better economic position. It's not as if they are expecting more cash flows from the land or anything like that. It's just that they swap these pieces of land simply to recognize almost a fraudulent gain and deceive investors. And so that's why we have these stringent rules around non-monetary exchange. All right. The first part is the most important thing within this entire topic is commercial substance. And what is commercial substance? And basically commercial substance means that because of a transaction, you would have a change in your cash flow position. So that could be the amount, sorry, I can't talk in this video. The amount of the cash flows, the timing of the cash flows, etc. And so what that means is, you know, if you were expecting to receive $10 million from a certain building or a certain piece of equipment, and then you traded it in, and now you expect to receive $30 million from this new piece of equipment, well, that seems like we have commercial substance because there's clearly a change in cash flow position, right? We were initially expecting 10 million, now we're going to get 30 million. Well, that seems pretty different, right? Versus when you do not have commercial substance, there basically you would say we're trading in two trucks that are both 5 years old and they're both going to give us, you know, $10,000 of value, okay? And so that would where we would call it lacking commercial substance. Now, if we have commercial substance, you can see this point here, it makes our life easy. And why is that? Well, we're going to go through these scenarios here just quickly, an overall 40,000 foot view of what's going on, and then in other videos, we're going to dive into some of the mechanics and some of the intuition and examples. So basically, there's these different types of scenarios. I've labeled them in big buckets. I say the exchange has commercial substance or it lacks, and then under lacks, we can see why it's more complicated. There's just more stuff there, right? So that seems more complicated. Exchange has commercial substance, the first part. The treatment, in terms of accounting, we recognize all gains and losses immediately. We do not defer anything, right? So we're not deferring gains, we're not deferring losses. That's when there's a legitimate transaction. We're trading something that's going to get us 10 million for something that's worth 30 million, right? So we'll recognize all the gains and losses associated with that transaction immediately. Then once we move to exchange lacks commercial substance, then we have these different sort of sub scenarios, if you will. And the first one is a loss situation. So if it's a loss situation, you exchange something, you have a loss, you always recognize it immediately. Always recognize all losses immediately. Okay? And then we get into the more challenging ones. Again, we're just going through the actual, just an intro. We're not going through any mechanics. We will do that in another video. Cash received and cash paid. So cash received, we're either going to recognize part of the gain or all of the gain. And then under cash paid, we're going to recognize either all of the gain or none of the gain. Okay, and so cash received meaning that in this transaction, I receive a certain amount of cash, and then cash paid meaning, okay, I paid out a certain amount of cash, okay? If I'm company XYZ, I'm paying out the cash in part C, and if I'm company XYZ, I'm receiving a certain amount of cash in part B. All right, so that's just an overview of what non-monetary exchange is and kind of what we're doing here. In some other videos, we're going to go through a formula that I have, and also some examples and some problems. So stay tuned for that, and I'll see you guys then.